Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our Primary Vision Frac Spread Count show. Unfortunately, we weren't able to do the econ show. I didn't have a chance to put it together, and we were away for Easter, so that's something that we'll come back with next week. But we'll have some slides in here just to kind of highlight some of the important things that we've been talking about. And then we'll get back to next week, the EIA show, the economy show, and then the Frac Spread show. And then next week, we're also going to pick up a bit more on the geopolitical side based on if anyone's been following with Russia and Ukraine, what's happening with China and some of those key components. And we'll touch on the China-Taiwan piece today, just when we start looking at what's happening with COVID and some of the increases in general. Without further ado, the Primary Vision Frac Spread Count is at 206, so we came down by just one. It's really kind of what we were really highlighting and what we were talking about, that we were going to see this increase, and then it was going to start to slow, and now we're going to get this back and forth. And the range can really now be between, let's say, about 205 to 215. We could get some increases, then decreases. And it's just going to be really with some of the smaller side basins. We do have more activity going on in the Uinta. We have more activity happening in some of the other locations. But the Permian, and Texas in general, is going to be fairly flattish from here on out. We'll probably start to get a little bit of an increase, but again, nothing really meaningful. And it's really going to drive now a bit more towards the rig activation. We have some increases that need to come across in the Bakken and Eagle Ford to really kind of bring up some of these DUCs. Obviously, there was the conversation now on DAPL. While they do the review, they're going to let DAPL run for the next 2 years because they're saying, I should say next year, because they said that the new environmental impact will be done by 2022. So, and there's not going to be a push to stop it while this is happening. So that's going to be something that will help be a bit more supportive of some Bakken activity, just because I know some people were waiting on when do they bring back crews, when do they start to ramp back up, and just because we continue to see some of these drop downs in Bakken production, while on the other side, Permian production continues to climb and is really offsetting some of the declines that we've seen in some other areas in general. So then when we look at the frac spread count, you can see we had that strong move, obviously, from the freeze off. And now as we're getting closer to past that 200, we're expected to see things kind of cool off. And some will get an increase at different times and a decrease as we have crews moving around. And because we're trying to get as accurate as we are as who is actively, completing wells at that moment. And typically there's a 30 to 60 day lag on when these crews come on, and then when we actually see the production, just given turn-ons. Is it a simu-stim, dual stim, depending on what your nomenclature is. Is there a delay? Is there just timing on when this will actually show up? But given where we sit now, over the last couple weeks, we're going to start to see some of this filter through onto the production side. And when we look at the big COVID drop, you can see that we're now crossing over, and we're going to sit at this point where this kind of just absorbing what is happening, getting used to the production at this point. And that's why over the next, let's say through April and even into May, we're going to be around this, 205, 215 with that 10 or so spread swing back and forth, especially just given where pricing is. There's really nothing saying that we're going to get this big push. Last week we talked about OPEC, and one of the things that we talked about this specific thing on the EIA show, but just to give you some of that summary, when we look at workplace mobility, we had some of that reduction just for Easter and for spring break, depending on when people have their spring break. Some public schools have it with Passover into Easter. Some of them have it after Easter. So it's just going to come back and when we look at the mobility by state, you can see that we're starting to see some of this, reduction in general to based on the baseline. But then when we look at the U.S. mobility and engagement, This is the one that we talk about every week, and this is the U.S. Dallas Fed. And we keep seeing that, we keep expecting to see this surge up on the weekends, and we're still not really getting there. But given it's going to be weather-based, there's going to be some lag in that. So this is going to be something to continue to watch, especially when we look at what are people doing? Are they getting more active? How much is the increase in diesel prices, gasoline prices impacting some of their activities? So that's going to be a big one that we always like to talk about, just to show the divergence that we're seeing on weekends versus weekdays, as we do have COVID cases rising back up. In the U.S., it's a bit manageable. It's a little bit of an increase, nothing too crazy. We'll probably see another increase just because I know for most, they saw their families this Easter. The bigger issue is really in the Asia Pacific, and we'll talk about that more in a minute when we look at India hitting a record amount of new cases. And then obviously Europe continues to see these increases as we have delays with J&J, as we have more delays with AstraZeneca. Again, that's going to impact not so much the US in general, but really Asia, Latin America, and Europe. But when we look at this, we always have to talk about, which is why we talk so much about restaurants, because I know it's at the end of this EIA segment too. You may not make it that far, but we do talk about restaurants every single week because this is going to be one of the bigger drivers of activity. And this is, I thought, a really good way of, where are people going to splurge on the other side of COVID? And restaurants, I think makes a lot of sense, try to get out. How many people have been cooking day in and day out, want to get out, have a little bit of that service, especially since it's getting nice out and you can sit outside comfortably. And then travel is going to be the one to watch because, is it going to be by car? Is it going to be by rail? Is it going to be by airplane? And that's why we're trying to look at those different verticals to understand what is that going to look like. And we've already seen some of this activity come back and now starting to pair off and normalize at this rate. And that's going to be the one that we want to try to understand a bit more in terms of not only just the gasoline side, but also the jet fuel side. Because we have gotten that resurgence of activity, and now it's starting to peter out a bit. But when we look at what's happening abroad, we always like to talk about the refined product availability because this stuff can go on boats, it can move around, it's mobile. So when we look at what's happened in Singapore had a build of almost 1 million barrels. And we had some drawdowns in Europe, but a lot of that is coming into the U.S. and we're actually seeing some of these shifts, when we talk about the physical market and just what's happening in general. So Gunvor sold 100,000 tons of Urals to Total April 18th to 22nd delivery at $235 less dated Brent. Previously that was $270, but then on the other side, Shell bought 100,000 tons from Trafigura for end of April, and they did it at $265, which is actually 5 cents below what previous prices were. And so we're getting really between this 235, 275 range, depending on how badly you want to move it. And again, this is at the low end of the range. The 270, 275 is a 12-month low, and if you think about where we are in April and where we were then, you get an idea of some of the pain there. Now, on the other side, when we look at Europe, so European oil product shipments to the U.S. rose in March, not surprising given what we talked about in the EIA show. About 2.6 million tons, mostly gasoline and blending components, sailed for the U.S. in March, the highest volume since January 2018, coming from Bloomberg. And then at least 4 European gasoline tankers are now floating off New York, while a 5th is en route from Italy to New York. So now we have this issue where there's a backlog. And this is what we keep talking about when we talk about timing, because we can see the boats. It's a matter of when does it offload. So even if, even though we have gotten, pricing has gotten better, we're still attracting additional barrels coming into the U.S., especially from a gasoline side. So the surge in U.S. shipments helped to lift total flows to the Americas to a 23-month high. Right now, we had 4.5 million tons in March, and now coming forward, we have what's going to come in April. So for April, we have 24 tankers which have already sailed, calling about 911,000 tons, and an additional 17 tankers have been booked to load 652,000 tons in the coming days. So this is what we keep talking about on this floating armada that continues to signal towards the U.S. because we do have the best crack spread or the best spread in general versus the other locations, especially when we look at COVID cases rising in Europe, or at least not coming down to the point. Germany's talking about what do they look like on a renewed curfew, some sort of lockdown to try to get some agreement. And then on the other side, looking on the West Coast, we have a big surge of Asian product coming not only into the U.S. on Pad 5, but also a resurgence of product coming into Europe, which makes sense when you look at some of the numbers that we have where gas oil is right around this 15-year average. So there's some flexibility there. Gasoline, they're trying to manage that. But realistically, it's on the gas oil diesel side that's coming over. But that's also going to hurt the U.S. because that just means that they're still not going to buy from the U.S. in general. So that just gives you an idea of kind of what's happening within that universe. But then when we turn to the economic side, the thing that we keep talking about is, the wealth effect, because we keep hearing about how people are going to travel, traveling is going to increase, but it's not going to be everyone, and it's going to be in a very small set of people, and the subset in terms of that grouping. And we will have people driving more, but even at this price, you're going to start to see a little bit of softness in terms of what can people tolerate, where when we look at gasoline demand for this week versus last week, we're falling back below where last week was, which makes sense if you think about, Holy Thursday, Good Friday, people traveling, so you're going to get on the road. So to be down week over week isn't crazy. It's just, what does this mean going forward? And clearly, those with the real estate and equity side, as we keep talking about, that it makes up the top 10%, benefited from equity and real estate. And then on the equity side, if we take it a little bit further, it's about 72% of America missed out on this trade. And that's why we think that there's going to be that divergence of the amount of people. There will be people flying, there will be people driving, but it's going to be from a smaller subset, which is why when we talk about how is inflation impacting different people, well, the wealthier you are, you're not going to concerts, you're not going to sporting events, you're not going to the restaurants to the same level, you're not flying as much. So those are things that you're just not spending on, and even if you're spending on it now, it's still cheaper than it was. So the inflation impact for the top 10% just really isn't at the same level, where when we look at the bottom 10%, that is where it's getting hit the hardest, especially when we look at jobs data, which we'll go through, and some of that inflation data that is going to continue to ratchet up as we look at those input costs that are going to be passed through. So then when we look at weekly claims, so we continue to see a surprise to the upside on jobless claims. The regular state is moving in the right direction. But then when we look at, again, the pandemic emergency, extended benefits, that's where we continue to see this stickiness. This is where we continue to see those headwinds where we're not able to really break below those numbers. And that's the concern, is because we're sitting in this stagnant point on the jobless claim side, with the most recent one coming in well above estimates. And again, maintaining this over 700,000 on the jobless claims. And then when we look at the total, still holding above that 18 million, which again, we want to see try to get below this. So then when we flip to the good data side. So one of the things that we had said last week was that we expected non-farm payrolls to come in at over 900,000. Here we are at 916,000 versus the estimate of 660, which is obviously a positive. And as we were saying, that the reason why we're going to get this jump is, again, restaurants, hotels, some of the leisure and hospitality side of the equation is getting better. But even though that's getting better, we're not seeing the same increase in hours worked or hourly wages, because these are typically a little bit on the lower side when we consider about what is that on an hourly basis? But so then when we look at non-farm private payrolls, again, manufacturing continued to go to the upside, which is something that we think is going to continue. But then again, when we look at hourly earnings, that was actually negative 0.1%, not positive. Hourly earnings year over year, instead the estimate was for 4.5%, came in at 4.2. Weekly hours, 34.7%, 34.7 versus the actual of 34.9, with the labor force participation rate really not changing. And that's all at the same time, as people start to feel better, they come back, and then that will also increase those numbers because you went from not looking for a job to looking for a job, so you get classified differently. But then when we look at that underemployment, it still remains elevated. So while it's a positive number, the quality of the number is still not there. But this is something that we're going to continue to watch and really think it'll change. But it's just going to be at a much smaller pace because this was that resurgence that we were expecting for restaurants, some of those capacity. And now we'll see additions continuing, but again, at a smaller pace and more measured to kind of continue this sharp bounce and now just sideways move. And this is what we're talking about with that sideways move. When we look at non-farm payrolls total, as we were saying, we expected this big spike, and now we had that move off the low, and the pace is going to level off. But job openings continue to be strong. When you look at Indeed, JOLTS, all of that, but they're not finding the right fit. And that's the biggest issue, which is why some of these job openings just are remaining in general. And we still continue to see these jobless claims with more companies announcing some layoffs on a global level, again, which is going to weigh on just some of that activity. Then when we look at stimulus, you can see what was stimulus used for. And just given where it was in general, most of this went into savings or paid down debt because a lot of the money was already spoken for because you either knew it was coming, so you put it on a credit card because you had to buy stuff. And just in general pricing, it doesn't go as far as it did. So even though you're getting the same amount, you're just not getting it's not moving through the system in the same way. So then when we look at PPI blew out estimates. They came in well above where estimates were on a month over month as well as a year over year. And the reason why we do both is because obviously year over year is going to have a very ugly base effect. But we want to appreciate is this just transitory? Is this something that's going to be sticky? And when we look back through the system based on prices paid, export prices, PPI abroad, you're seeing the whole supply chain seeing that prices are going up. So even though obviously we're going to start to level off a bit, it's still it's not going to come back down. And that's going to be the biggest problem as some of this continues to get pushed through the system. And now when we look at, the China PPI, because this is another one that's really indicative of problems throughout the whole system. When we look at PPI in general, this had another big surprise to the upside. And this is something that, when we think about where is this going to go in general, this will get passed through. We're already seeing export prices go up. We're already seeing those increase in costs in general on an international level. And it's not just China. We're just picking on China just because the data just came out. So there's those issues that are going to impact exports in general, but it's also going to impact local, which is why we keep talking about demand. So the most recent holiday had, in terms of pre-pandemic travel, they had, there was a holiday that was Friday to Monday. 94.5% traveled, which is, again, just almost 5% off, a little bit more than 5% off of normal. Again, that's a net positive in general, but on a spending side, spending was only 56.7% of pre-pandemic levels. This keeps coming back to the supply versus demand situation. You're just not seeing the local demand within China, which is why we continue to see a lot of this stress on the economy in general, why we remain concerned on the Chinese economy. Now, when we look at that and then take in what's happened so far, so the U.S. State Department set new guidelines to make it easier for U.S. officials to interact with their counterparts in Taiwan. You had China moving, they had Chinese naval assets within the Taiwanese EEZ. You're now having the U.S. increasing commentary and relations with Taiwanese political counterparts. Then you look at Japan. Japan has now built monitoring installments on several Indian-controlled islands that can track, submarines and things coming out of the Strait of Malacca. We're continuing to see relations increase between Japan, Australia, the U.S., South Korea, and India, and this is again countering some of that Chinese aggression that we continue to see and Chinese movements as the U.S. makes its own, pushback in terms of trying to meet some of these adjustments. So not only do you have the geopolitical side, but now you also have just the inherent economic. And how does China replace the U.S. and how does the U.S. replace China? Because clearly they're not buying locally and prices are going up for the U.S. So how do you adjust your supply chains? Again, these are things that even though we talk a lot about this, it's going to be hard to see this and it's going to be a slow move, which is why we're following it so closely. Then when we look at India, you can see India, this is as of the 4th, you continue to see this big push in COVID cases. But when we look at oil product consumption in March, which rose 17% year over year, which is the most since 2016 at 18.8 million, which is obviously a positive. Month over month, it's not as impressive, but still year over year, it's very strong. Gasoline consumption was 2.74 million tons. Up 27%, diesel consumption up 28% to 7.22 million tons, highest since December of 2019. Now think about where March was, which is why we expected to see some increase and then a drop as you got those, you started out, February started to get a little bit rough. And then, as we progressed through March, we saw COVID cases continue to rise and some state-bound lockdowns, but we did get the lockdown index on a national level getting better. So again, some of this is going to start to weigh where we got this nice big hop in March, and now we think we're going to get a fade in April. And especially when we start looking at, obviously, what we talked about with Singapore and some of the flows that we continue to see as COVID cases continue to ramp up, which is going to impact not only just the industrial side, but also that gasoline consumption. And when we talk about inflation, especially in India and some of these other countries, we have to look at, the UN just put out their new number for Food and Agricultural World Food Price Index, and shocker, I know, it's back to a multi-year high, and it's continuing to drive higher. Just after WASDE, some of the commentary in terms of exports and what's happening in the market, prices are not normalizing anytime soon. These are going to continue to drive higher in general. And then when we look at some of the other residuals, when we look at PMI, so PMI in the U.S. got better, 57.2, obviously a strong driver. The issue is, services PMI was at 63.7, obviously a very big driver, very strong move. But when you look at business employment, it got better, but again, not to the same level. It's still, it's in an expansionary territory, but we'd like to see it getting a bit stronger. But when we look at business prices, that's the one that concerns us the most, because that is where we continue to see these prices continue to push up. And these companies are not going to eat these prices for the good of the economy. They're going to try to pass through as much of that as they can. And that's why we continue to see this inflation continuing to push through as those price increases find their way to the consumer. And while it finds its way to the consumer, we keep talking about the shift in the middle income areas. So you can see here, high income, upper middle income, all continue to contract. And this is looking, again, a global middle class. And then the poor had a big increase in general. And again, this is the issue that we see on that longer term recovery in just general oil consumption, gasoline consumption, diesel consumption. And then when we break it out a little bit differently, this just shows you the developing world's shrinking middle class. So reduction in the estimate combined size of middle and upper middle classes in 2020, the developing world lost about 134 million people. Obviously, India, South Asia, a lot of these countries, it's not that they're going to stop purchasing. It's not that they're going to stop buying gasoline or diesel. It's just they're not going to get back to the pace they were on prior to COVID, because these are going to be residual issues. The inflation is coming through, which is going to impact the way they're spending. They're going to have less money to spend on different things. And then at the same time, it's just how much stimulus can they push through? I mean, there is a limit, especially in the emerging market side, on the amount of stimulus that can be pushed through on a fiscal and monetary level, which is why we talk so much about rates and the ability for them to just go out and borrow without seeing a huge increase in inflationary pressures, which is why some central banks have started to get more hawkish. We're seeing rates starting to go up, which is why we talk so much about the US 10-year, because that's kind of the gauge that is used to set some of the long end of the emerging market curves as COVID cases continue to be a problem, not only just in Latin America and Europe, but also Asia. Latin America, now Argentina is having a renewed protests against increase in lockdowns. We know that Chile still is sitting there, and the issues still remain within Europe, which is why we continue to see that flow coming to the U.S. Limited exports, increased imports. Again, you see those builds happening in the U.S., and then the pressure with just without having an outlet into Asia as well. So again, all of these shifts are going to keep more product locked in the U.S. as prices continue to squeeze the consumer. So, I know we covered a lot. If you have any questions, please reach out. We're always happy to have the back and forth, and then we'll cover some of this in more detail in the economy show next week. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Have a great weekend.